going back to the September time frame, we started to change our tech narrative a little bit, and we suggested that in here, Martin, Nvidia becomes, quote, just another stock. Now, what do I mean by that? What I mean is that over the past 18 months, the beat and raise dynamic that's come with Nvidia has been phenomenal, right? And what it's supported is this massive outperformance versus the rest of the index in most parts of tech. What we've been seeing, though, is a deceleration in the step function of where those forward expectations are going. This quarter is more or less in line with that. And what that means, again, just to emphasize, at a 6% plus weight within the S&P 500, this is mission critical stock to the ultimate S&P 500 performance. But as you see this decelerating rate of upside surprise, you have to allow for the stock to be a bit more transitory from a trading perspective. So what you've described in terms of the commentary thus far, what this does is reinforce conviction in the longer term. Let's call it 1 to 2 year growth projection. I think right now consensus expectations for next year growth for Nvidia are right around 40%. That's pretty heady. That's relative to the rest of the Mag 7, which are projected to grow 20%. And that's relative to the other 493 within the S&P that are still struggling to find earnings growth expectation bottom for next year. So all told, we're comfortable. The underlying growth trajectory is in place. And ultimately what that means with Nvidia, it actually has a little bit of a safe haven dynamic to it because of the visibility of fundamentals relative to the rest of the market.
Interesting, but okay. Top down though, this is still a company which is decelerating, right? And talking about deceleration, the S&P SPX is at about 5,900 right now. You're calling 5,600 by the end of this year. That is deceleration, and sort of goes against the grain of what a lot of other people are calling for right now. I mean, right now they're baking in a lot of optimism ahead of Trump 2.0 and thinking, look, if there are problems, it's going to start showing maybe 12 months down the line, not by the end of this year. What is behind this 5,600 call on SPX, Scott?
Well, Martin, we set the 5,600 at mid-year, so at the end of June, and at the time we were ahead of consensus and were deemed more bullish. And obviously, the markets worked through us. We've had a much stronger valuation tailwind to the S&P 500. With that base forecast of 5,600, we had also put out a bull case of 6,100. So what we had argued, Martin, going into the election a couple of weeks ago was that in a Trump plus red sweep, you would expect a follow through to the upside. And we suggested as we got closer to our 6,100 bull case, we'd be inclined to lighten up. Why? Well, yes, while we're talking about the visibility of this Mag 7 and Nvidia cohort, which is very much intact, our concern is that the valuation starting point for looking ahead into this unfolding Trump regime is very high. We're nearly 25 times trailing earnings and are right around 22 times forward. We think soft landing is very much being discounted in the S&P currently. And as part of that valuation setup, what you're doing, in our view, is paying forward to a certain degree for next year's earnings growth. So that's why when you get these quarterly reports, what ends up happening is the report itself is important, but it's really where forward guidance is going that becomes the real toggle in the shorter term price action. Bottom line on this, though, is that, in terms of where we think earnings progressions go, we do look for growth next year, but we think consensus is too aggressive. That's before we get to the Trump policy platform and tariffs, which in our view could be incremental short-term negative.